It's Thursday, January 29th, 2026. Microsoft dropped 10% in one session. Oil jumped more than 3%, and the Nasdaq still closed lower. This looks like a normal tech wobble. The mechanics say it was a three-shock day. By the end, you'll know what actually moved first. You'll know how it spread across markets. And you'll have 3 signals to track this week. Quick disclaimer, this is education, not financial advice. Here's what happened in plain facts. Reuters reported Microsoft fell 10%, its biggest drop since March 2020, after investors balked at record AI spending without matching growth. The tech damage spread across software. Tesla fell about 3.5% after earnings, while Meta surged over 10% on upbeat guidance. The index moves looked small, but the internals were not. The S&P 500 slipped 0.13%. The Nasdaq fell 0.72%. The Dow was slightly green. At the same time, Reuters flagged geopolitics re-entering the tape. Fears of potential U.S. military action against Iran pushed crude higher, with U.S. crude around $65.42 and Brent around $70.71 per barrel in the reporting. Brent above $70 was framed as a fresh high since July. Metals were whipping too. Gold hit a record high at one point, then eased on profit-taking. And there was a domestic policy layer. Reuters tied the volatility to the threat of another U.S. government shutdown. So, you had 3 shocks: AI economics, geopolitical inflation risk, and policy uncertainty. Now the real question is transmission. Which shock drove price? Start with the visible damage. Tech got hit hardest. This was not a broad earnings collapse. It was a valuation and trust issue inside AI spending. AI CapEx is a promise about future cash flows. When the market doubts timing, duration gets punished. Duration is paying today for profits far away. Tech is rate sensitive for one reason. The discount rate matters more. A small move in yields changes the math, but yields did not have to spike for this to hurt. All you needed was less patience and more proof. Receipt moment 1. Look at the magnitude. Reuters is explicit. Microsoft down 10% in a day. In a market trained to buy dips, that is a message. The marginal buyer stepped back. Liquidity in a crowded trade can vanish fast. AI is now being valued like a business, not a slogan. Now layer in the oil move. Oil rising on Iran risk is not new. The timing is the point. When oil jumps on geopolitics, markets ask 2 questions. Does this change inflation? And does this change central banks? If energy stays higher, inflation expectations firm. That can keep rate cuts priced later, and firm yields are a headwind for tech duration. Reuters framed the move as a reversal risk to disinflation. Now add the shutdown layer. Shutdown risk is a volatility amplifier. It changes hedging behavior into deadlines, even if the event never happens. So, what did volatility do? On the close, the VIX ended around 1688, up from the prior days. That is not panic, but it fits a choppy tape, not a smooth trend day. That close is visible in the Fred series for VIX. Markets can have a risk day without a VIX explosion. Sometimes the story is concentration. One sector gets hit, another holds up. Index level moves look small, but cross currents are strong. Now bring in the rate tape. The 10-year Treasury yield was about 4.24% on January 29th. According to the DGS 10 series, tech sold off even without a yield spike. That points back to confidence, not just rates. So, what broke first? The clean read is this. AI bubble fear hit equities first. That showed up as a sharp, tech-led repricing. Geopolitical risk hit commodities next. Shutdown risk sat underneath as an uncertainty layer. One reasonable read is markets repriced fragility. Fragility is concentration and narrative dependence. Now, translate why it matters. If AI spending is questioned, CapEx plans get scrutinized. That matters for suppliers and hiring. It also matters for credit, because CapEx can lean on issuance. If oil stays higher, inflation risk stays higher. That matters for rates. That matters for household borrowing costs. If shutdown risk escalates, it can hit confidence. That matters for volatility into the next data week. One more detail makes the day hard to read. The index hid the drama. Meta was up double digits. Energy stocks were higher. That can offset a tech slide in headline index points. So, the S&P looks barely down, while tech felt heavy. Reuters called out the technology sector as the weakest group, down about 1.9% on the day. That matters because the market was really a sector story. That is why people felt whiplash. You could look at the Dow and think nothing happened. Then you open the tech tape and see a different world. This is a concentration problem. When a few names carry the index becomes a mask. When one of those names cracks, it feels larger than the headline. Now, zoom out to the cross-asset move. Oil up over 3% is not just an oil story. It is an inflation expectation story. It is a margin story for companies. It is a spending story for households. And it is a rate path story for central banks. If you want the simplest spillover chain, it is this. Higher oil can lift inflation expectations. That can keep real yields from falling quickly. Higher real yields pressure long-duration equities. Long-duration equities are where AI lives. Gold's behavior adds a second layer. It hit a record high, then pulled back. That often happens when hedge demand meets crowded positioning. It does not prove anything by itself, but it tells you hedging showed up, then cooled. Now, connect that to credit. When markets are calm, credit spreads stay tight. When a shock becomes systemic, spreads widen. On this day, spreads did not blow out. So the tape was warning, not confirming. That is why calling it a crash is wrong, but calling it nothing is also wrong. It was a repricing of narratives with mixed confirmation. Receipt moment 2. Put these two numbers on screen. Brent around 70.71 in the Reuters reporting. VX close around 16.88 in the Fed print. One is inflation risks, the other is hedging demand. Together they tell you this was not one clean story. Here's the frame for what comes next. You are watching which shock becomes dominant. AI economics, oil-driven inflation risk, or policy-driven uncertainty. Next, it comes down to 3 signals. Signals you can check in under a minute. Signals that tell you which story is winning. You are watching which shock becomes dominant. AI economics, oil-driven inflation risk, or policy-driven uncertainty. Here are the 3 signals. These are the only 3. Everything else is noise. Signal 1 is crude oil. Look at Brent or WTI. Direction that matters is simple. If crude stays bid for a week, risk stays alive. If crude fades back fast, the tape de-stresses. Typical lag is immediate to 24 hours. Crude moves first when geopolitics leads. Why oil is signal 1. Oil is the fastest inflation headline. It changes expectations before data does. If oil rises and holds, break-even's firm. Then the front end reprices, then tech duration suffers again. Where to look? For prices, use ICE Brent or CME WTI quotes. For receipts, use settlement charts. The key is not one spike, it is follow through across sessions. If oil keeps rising, watch 2 things. Energy equities and the dollar. Energy equities confirm, supply fear. Dollar direction tells you risk off versus policy risk. Signal 2 is the 10-year yield. Direction that matters is a steady grind higher, or a sharp drop that signals growth fear. The lag is 1 day to 1 week. Yields do not always move first. They validate the equity story. Why yields are signal 2. Tech is long duration. Long duration hates higher real yields. If the 10-year yield stays near 4.24% and drifts up, pressure remains. Fred.sluisfed.org. If it drops while oil stays high, that is different risk. That is stagflation fear. It is rarer, but louder. Where to look? Use the Treasury Constant Maturity Series. The DGS-10 print is a clean reference. Fred.sluisfed.org. If the yield moves with oil, inflation is leading. If the yield moves opposite oil, growth fear is leading. Signal 3 is credit spreads. Use investment-grade spreads. The direction that matters is widening for several sessions. The lag is 2 days to 2 weeks. Credit moves slower, then it moves fast. It is the confirmation layer. Why credit is signal 3. Equities can overreact. FX can whip on positioning. Credit usually demands payment for risk. When IG spreads widen, funding costs rise. Then buybacks and capex get questioned. Then equity volatility sticks. Where to look? Fred has ICE BOFE US Corporate OAS. It is not tick by tick, but it is clean. fredslewisfed.org. If it turns higher and stays higher, the calm is gone. Now, connect the three signals. If oil is up, yields are up, and spreads widen. That is broad repricing. If oil is up, yields are flat, and spreads stay tight, markets are fading it. If oil fades, yields fade, and spreads stay tight, the day was a one-off. Now, the catalyst window. The next 24 hours is headlines. Iran-related updates can swing crude fast. Shutdown headlines can change hedging demand. Those are not forecastable. They are checkable. The next 72 hours is positioning. If tech cannot bounce, the market is less forgiving. If the bounce is sharp, the tape is still by the dip. The next 7 days is data and policy. U.S. inflation and jobs. Data can reprice the rate path. Central bank speakers can harden language. If data surprises hotter with oil high, yields can jump. If data surprises cooler and oil fades, risk can calm. Now, the core mechanism chain. Step 1 is narrative risk. AI spending became a timing question. The market demanded proof, not promises. Step 2 is discounting. Less confidence makes far future cash flows worth less today. That is why duration breaks first. Step 3 is cross-asset feedback. Oil up tightens inflation conditions. Higher inflation risk keeps cuts priced later. Later cuts keep real yields firm. Firm real yields pressure tech again. Step 4 is uncertainty premium. Shutdown risk raises the cost of protection, even if the event never happens. That makes liquidity thinner into deadlines. All of this matters because concentration is still high. When one megacap cracks, it changes index behavior. It changes flows. It changes passive demand dynamics. It also matters for credit supply. If AI capex continues, bond issuance can rise. If spreads stay tight, issuance clears easily. If spreads widen, supply needs concessions. That can slow capex at the margin. That can feed back into growth expectations. So, what could break next? A second large AI name missing expectations, a sustained oil bid that changes inflation psychology, or a policy deadline that forces dealers to de-risk. None of those is guaranteed. The point is mapping the chain and watching the signals to confirm it. One more receipt you can show, a simple 2-panel screen. Left panel, Microsoft down 10% on the day, per Reuters. Right panel, Brent above $70 in the Reuters print. Those two together explain the mood, Reuters.com. One subtle point is the split inside equities. The Dow was slightly green, the Nasdaq was down. That happens when duration names get hit, and when energy and defensives hold up. If you want to see that split clearly, compare equal weight. Equal weight removes concentration. If equal weight holds while cap-weighted falls, pain is top-heavy. That often means not full risk off. It is rotation inside the tape. Earnings dispersion adds to it. Meta surged on guidance. That is a different story than Microsoft. So, the market is not rejecting tech as a whole. It is rejecting the part of tech that looks like an open-ended bill. That is also why volatility can stay moderate. If one group is collapsing and another is lifting, net moves look small. Protection demand rises, but not to panic levels. Shutdown risk sits in the background as a calendar trade. If lawmakers drag it out, short-dated hedges get bid. Liquidity can thin in intraday moves. That is not prophecy. It is behavior. If a shutdown is avoided quickly, that premium can evaporate fast. If the deadline gets extended without clarity, it can linger. That is why the crude move matters more. Oil is a fundamental input. Shutdown risk is uncertainty premium. So the clean hierarchy is this. Oil is the fastest fundamental risk. Yields translated into discount rates. Credit tells you whether the system believes it. Keep that map. It prevents overreacting to one red day. And it prevents ignoring early stress. The last piece is what to do with it. Most people see a headline and pick a side, bull or bear. This channel does neither. It maps the chain and checks the tape. So, here is the clean recap of January 29. Shock 1 was AI economics. Microsoft's drop was the receipt. A 10% single-day move is a message. It says the market wants timelines. It says the market wants margins. It says open-ended spend is no longer free. Shock 2 was geopolitical inflation risk. Oil jumping on Iran, fear was the receipt. If crude pushes higher and stays there, it changes the inflation path. That changes rate pricing. That changes discount rates. That is why tech can sell off on an oil day. Shock 3 was policy uncertainty. Shutdown risk added friction. It can raise hedging demand into deadlines. It can thin liquidity on normal news. It does not need to happen to matter. The important part is how those shocks interact. When oil rises and growth fear rises too, correlations climb. Tech becomes the release valve. It is liquid, it is crowded, it carries index weight, so it absorbs the punch first. When oil rises and yields rise with it, the story is inflation. When oil rises and yields fall, the story is growth fear. When oil fades and yields fade, the story is relief. That is why you watch the trio of signals, not your favorite headline. Now, what could surprise people next? A lot of viewers will look for a rebound day and assume the risk is gone. That is not the right test. The right test is whether the market stops paying for protection. The right test is whether credit stays relaxed. The right test is whether oil stops setting the mood. This week, the market has two ways to calm down. One is crude backs off and stays off. That reduces inflation anxiety fast. Two is tech earnings stop scaring investors. That restores confidence in the capex story. And it has two ways to stay tense. One is crude keeps climbing and pulls inflation expectations up. Two is another mega cap, shows weak payback on spend. That keeps the duration trade fragile. Notice what is missing. There is no prediction. There is no certainty. There is only a map. So here is your simple checklist for the next few sessions. First, check crude. If Brent and WTI stay elevated for a week, assume the risk channel is active. If crude spikes and then fades, assume the shock is contained. You are not trading it. You are reading it. Second, check the 10-year yield. If the 10-year grinds higher, pressure on tech stays. If the 10-year drops while crude stays high, watch for the market shifting to growth fear. That is when volatility can feel worse than the index suggests. Third, check investment grade spreads. If spreads stay tight, the system is still functioning. If spreads widen for several sessions, the shock is spreading into funding. That is when equity rallies fail faster. Those are the three signals. Nothing else earns a spot. Oil, yields, credit. Here is how the next catalyst window tends to hit those signals. If there is an Iran headline, crude reacts first, sometimes within minutes. If the headline is later denied or softened, crude can give it back fast. That is why you care about the close, not the intraday spike. A week of higher closes is the real tell. If the calendar shock is Washington, the first move is often volatility and equities. But the confirmation still runs through credit. Shutdown risk becomes market risk only when it threatens confidence. If lawmakers resolve it quickly, the premium disappears. If they drag it out, the premium lingers and makes every other move feel worse. If the next catalyst is data, the yield does the translating. Hot inflation or strong jobs can lift yields even if equities want to rally. Cool inflation can drop yields even if headlines are messy. That is why yields sit between crude and equities. They convert stories into discount rates, and if you want a clean way to tell whether this is a one-day rotation or a deeper change, watch who buys the dip. If dip buying shows up only in the same crowded names, it is fragile. If dip buying spreads wider and credit stays tight, it is healthier. If dip buying disappears and spreads widen, risk premium is being repriced. This is not about being dramatic. It is about being precise. The danger is not missing a headline. The danger is misunderstanding transmission in real time. Now, one practical way to avoid getting fooled by the index. Look at breadth. If equal weight holds while cap weight sinks, it is concentration pain. That can reverse quickly. If equal weight breaks too, it is broader risk off. That usually lasts longer. Treat that as context, not a fourth signal. Also watch how winners behave. On January 29th, Meta surged on guidance. Energy held up with oil. That split tells you the tape was rotating, not collapsing. Rotation days are noisy. They tempt you to overreact. They are also where the best information lives, because they show what the market is willing to pay for and what it refuses to subsidize. Now, the core message for Risk and Recap. A tech wreck headline misses the mechanism. This was not just tech. It was a stress test of narratives. AI spending without clear payback got punished. Oil-driven inflation risk tightened the rate story. Policy uncertainty thickened the air. If you remember one line, make it this. Markets can be calm in the index and stressed in the guts. That is why receipts matter. A 10% drop in the biggest names matters. A jump above $70 in Brent matters. A VIX that rises but does not explode matters. Those are not vibes. They are observable prints. Now, keep your expectations realistic. A single session does not end a cycle. A single rebound does not fix a narrative. The next week decides whether this was a hiccup or a regime shift, and the decision will show up first in those three places. Let's close it clean. What happened? A stacked shock day hit the tape, with AI doubts, oil risk, and shutdown pressure. Why it happened? The market repriced confidence in future cash flows, then layered in inflation risk. Why it matters? It can tighten financial conditions and change the rate path, even if the index looks fine. What to watch next? Crude direction, 10-year yield direction, and IG spreads direction. That's the risk, and that's the recap. If you want the clean signal check, look at those three markers this week. I'll see you in the next one.